This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe. Welcome back. So I want to talk about, it's actually a follow-up video to the KISS video I did last week. So last week I discussed the KISS method, what I call the KISS method, which is keep it as simple and stupid as possible. Now, there are some variables there. It's not like it's just, if this does that, you buy, and if it's this does that, you sell. It's not that simple. But it is a plan that you can follow, and it's something I'd recommend for someone who's new to trading or going through a struggle period, and you're just looking to have an approach that they can put on trades and try and improve their consistency. So if you haven't watched that, I do recommend going back and watching. However, what I want to talk about today is a byproduct of that when we're in an environment where, let's say the market's running to the upside and has gotten maybe a little too far, it's gone a little too crazy, and we're starting to see signs where maybe it looks like it's starting to top out, or we've gone through a big decline like we have recently, and a lot of stocks have accelerated to the downside, might be showing signs of momentum divergence where you're not getting the confirmation that I look for in a trend. Maybe you don't have that parallel line anymore, or the 18 is accelerating at too fast a rate, so you're not really looking to play it anymore. When that happens, we want to start looking for another like a turnaround pattern. So I want to show you how I go about doing that in 2 time frames. Let's go ahead and get started in this. So on the right is actually what I discussed last week. So I was looking at, do we have, and let's just say this is the 18, okay, and that would be the 40. So this is the 18 on the downside, and we're looking for that to be moving at a rate that is not flat and it's not accelerating, okay? It's not to the point where it's almost, if we're going up, it's not vertical, right? And then it's not losing slope and kind of working sideways. If you have something that's got a pretty good slope to it like that, then you can play pullbacks with it, okay? And again, you can go back and watch that video to get that method in place. Now, if you don't have either one of these, what I would recommend is be on the lookout for my 1, 2, 3 pattern. Again, all this stuff is in my book. Now, what I would tell you is that this is a more advanced setup, and the reason is that you're doing it in anticipation of a change in trend. It's not complete because we want to enter on the 2 on the higher time frame. So we break the trend line. That's 1. We get we get some move to the upside. We get a pullback, typically right in the area of the 18 on that pullback. That's the key for me. On this specific method that I'm going to show you, sometimes we get a 2 that comes all the way down to the low, and what I would recommend is some kind of a move back up and then test the 18. I'm looking for the 2 to be testing the 18. Now, sometimes what can happen is you can get a 2 that where we get a pullback here, and then it actually triggers the 3, but it's really a far move, and then you wait for kind of 2B, where you're getting a second chance of doing kind of the 2 version at the 18 MA. So those are a couple different things just to be on the lookout for. I mean, I understand that's 2 is making a low. If it's below the 18, we probably want to see a little bit more strength. Now, sometimes I will play it down here and make a move back to the upside. But I'll just give you a few examples today of how I would go about doing this. Now, the point I wanted to make here is that we want to buy on the higher time frame. We want to buy at the 2, but we want to go and find the opposing trend trigger on the lower time frame. So if I'm looking at a daily chart, the higher time frame would look like this, and we're getting a pullback on the daily to the 18, and then the lower time frame is going to actually be an opposing trend where it's been making lower highs and lower lows, and we're looking for a reversal on that time frame. I'll show you an example of this. So actually, let's go ahead and get into that. And what I've got right now is I've got Johnson & Johnson up. I've got the weekly chart here, the daily chart in the upper right. In the upper left, I have an hourly, and then in the bottom left, I have a 10-minute. And I want to just draw in my trend line just like I'm doing my 1, 2, 3. Okay. Now, let's zero in on this time frame for a minute, because I want to go back to what I was discussing about the 2 and be a little bit more careful when we get a break of the trend line. That's 1. Now, notice how this 2 came down. I mean, that is a 2. There's no doubt about it. But look at the price action in the process. Do you see how it violently broke through the 18? Do you see all the overrun we have in MACD? You see the selling pressure we had here? That's a pretty big selling pressure to the downside. So I don't know that I want to just jump the gun and buy the 2 right here, right? You see that? That's a break of the trend line. We got a 2. I mean, I don't really want to fight this on the first go around. And I don't want to do it when I'm below the 18 in this instance. Okay, overrun here, some selling showing up here. We are looking for a reversal. And let me just explain why. Because we came down to pretty good support on the weekly chart, right around the 40-week moving average. And there wasn't a lot of selling pressure. You see how negative DI didn't do much? And what you don't see is the relative strength in this has been very, very strong relative to the S&P. The other thing is, if we look at the daily chart, we had a move stretched away from the 18 MA down here. And we were normalized oversold on the MACD, normalized oversold. Okay, this means we are stretched away from the 0 line, but we're not ferociously selling off in a way that leads to a lot more decline. This is a little bit more like ferocious downside move, and I don't know that I would call this normalized oversold. And you notice how it really spent a lot more time where these came down and just reversed a little bit more quickly. I would consider this more of a normalized oversold pattern. So we have that, and we're coming into bigger support at the 40-week. We're stretched away on the daily chart. So is it a trading play? It's definitely a trading play. I mean, don't get me wrong. It's not like you'd necessarily do this off of an hourly chart in the expectation of a breakout, but you could do that and keep the risk down if you want it. But I'm laying the groundwork for something that looks like a pretty good trade. Now, I've got the break of the trend line. I've got this test. But because it was so violent, I would probably let this move up like this and then play the test of the 18 here. Do you see that? I mean, that to me is a much better setup. Now we have worked this major decline off. It had a test and then it did it again. I don't like to buy the first decline or the first reversal when we have that much overrun in MACD. And then if you notice, we came here. The selling pressure was, not as strong on this peak, but then we came down and made another pullback here, and red DI is actually below green DI at this point. So I'm starting to feel a little bit better about this. Now, I know what some of you guys are going to ask. You're going to be like, this doesn't really look like a reversal, but I think if you're playing a reversal in the trend, you have to realize all these little spikes. You see all these gaps and these spikes. When you're down on an intraday chart, this is going to lag. ADX is going to lag because you have spikes and gaps and everything. You have to be very careful about looking at the letter of the law and saying, oh no, this just made a big peak. I can't buy this. You have to be really careful, especially when you go down to the lower time frames that are an hourly or less. When it comes to ADX, gaps have a massive impact, and big spikes have a massive impact on ADX that has a hard time to recover quickly. So keep that in mind. I do like to look for price action. If you notice here, green DI did get going again. So we had a low ADX, and green DI is starting to come up as this is turning around and forming the 2, which I showed in the image. All right. Now, if we go to the 10-minute, it should make it a little bit more clear. I mean, this was the gap down version of the 2. That is just too violent. There's no pattern here. I don't see anything here, and I definitely don't see anything here. Now, we get another move to the upside. That's the second one, and this is where we're pulling back to the 18 on the hourly chart, and we get the opposing trend to set up here, and we get this green bar right here. See this green bar? We came in the zone, came out. We actually had a close below. So we had our setup right in here. And then it moved down a little bit, held the 18, and then we have our green bar. This isn't official. That is definitely a trigger, that close right there. But if you're going to do that close, you got to use this as your stop. You have to give it room. You can't have a really tight stop. You can't put it here because we haven't reversed the trend back to the upside yet. All right. Now, when this comes down, makes a better test of the low, and then we get this violent move to the upside, then you can come below the last low. Okay, and then I can come down below this last low. In this case, it really isn't much of a higher low, right? But once we get this action here, then I'm good with coming to this low and not having used the low of the whole bottom, all right? But we need a completed reversal to take place. And I guess what I'm looking for is, a strong bar. MACD closes back above the zero line, back above his signal line, above zero. And we get kind of at least some signs that things are going again. See green DI getting going again. Then I can feel like I can start to raise the stop. If you do it ahead of that, you're probably going to get stopped out a lot. So if I stop here because I have this big green bar, you're getting stopped out, right? I mean, so you got to be very careful at the beginning, early stages, because I like to get in sometimes here. For me, it works really well doing this and doing this. And the reason why is that I can't watch stuff nonstop. I'm on calls with clients nonstop. I'm doing, I'm making presentations, I'm doing videos and stuff like that. And sometimes I'm doing that during the day. I can't sit there and watch every bar on an hourly chart. So if I see that trigger, I can put this in and I know I can give it a little bit more room. It's a different strategy. I mean, if you want to play this game, you get in here and you put this here, then you have to be ready for the next entry. Okay. So, it creates a little bit more work, but there's no problem doing that. You're going to have less risk when you put on those trades. But I personally would tell you that I think if you use this wider stop, your overall numbers are going to improve. So I hope this makes sense. I wanted to make sure I covered this when we look at a trade where it's a 1, 2, 3 reversal, and I want to get in on the 2 portion. I don't want to wait for the 3 on the higher time frame. See what I'm saying? Like, I don't want to get in on this breakout up here at 172. I want to go down to the smaller time frame, somewhere around the 170, 170 and a half or something like that. So I'm going to save myself a couple points in most cases, if I'm doing it this way, finding the entry off the smaller time frame, because this entry here using this close was 170.3, and taking out the high here was around 172. Yeah, it was about $2. And so, I mean, to me, that's worth it. I'm going to have a much better risk reward in this setup. And, if I can do it that way, and I know that this time frame's getting going again, I have a higher probability trade. All right, go ahead and post any questions or comments. Thanks.